The global financial crisis over the past few years has caused regulators worldwide to enact legislation to address solvency and capital for insurers. This includes Solvency II in the European Union, which insurers must comply with by the end of 2012, and pending legislation such as the Solvency Modernization Initiative in the United States. Leading insurance organizations are making investments for compliance and leveraging these investments to build a foundation for overall enterprise risk management. Today, insurers have siloed views of their risks. For example, underwriting risk is addressed by actuaries. Interest rate risk and financial risk is addressed by chief financial officers, and operational risk is addressed by operational risk managers. With the SAP BusinessObjects Enterprise Risk and Solvency Management for Insurance Analytic application, insurers can gain an enterprise view of their risks and better understand risk exposures and capital required, enabling them to make better business decisions for capital allocation and their overall business strategy. Let's take a look at some of the dashboards and reports in the SAP BusinessObjects Enterprise Risk and Solvency Management for Insurance Analytic application. Currently, we're viewing the Solvency Summary dashboard. As we can see from our selectors, a company can view their key solvency metrics at the group level or the division or individual company level. Further, they can view their solvency on either an annual or a quarterly basis. There are 4 quadrants on our dashboard to view our key performance indicators, or KPIs. Let's look at our solvency capital requirements coverage. We see that there are 2 major indicators: solvency capital required, or SCR, and our minimum capital required, or MCR. We can see that we actually view these 2 requirements by 5 metrics: the absolute amount for SCR and MCR expressed in euros, SCR and MCR ratios of eligible capital to capital required, and the ratio between the SCR and MCR amounts. We can see these figures develop over a period of 4 years, and as we hover, we can see the SCR absolute amount, our MCR ratio, our SCR ratio, our absolute MCR amount, and again, the ratio between these 2 requirements. As we look at our speedometers, we can see our minimum capital requirement is okay, but marginal, as it's getting closer to the yellow range. And we can see that our solvency capital required is definitely marginal. So let's look further and see what's contributing to this. If we look to the right, we can see our risk components in the upper right-hand quadrant. We can view the risk component breakdowns and view via the line graph how the various risk types are changing over the years, as well as our overall diversification effect. However, we notice that our life underwriting has gone up in 2008 to 2009. Next, we may now want to view our own funds or our eligible capital to cover these risk exposures. We can see the capital required is increasing, most likely in response to the uptick in our life underwriting risk. In our 4th quadrant, we can also see our capital that is attributed by tiers, or Tier 1, Tier 2, and Tier 3. We can also see the breakdown of our capital allocated by basic, ancillary, and total owned funds categories. We can view the SCR by specific risk type, comparing the change from prior year, and see an increase in life risk. This increase could be due to one of several factors. The most likely factors are either a decrease in our asset performance or an increase in our liabilities. To investigate further, let's take a look at our balance sheet dashboard. As we look at our balance sheet, again, we see our selector for company, or group versus company. But we also see a new selector for liabilities or assets view. Let's view our assets first. We also have selectors to compare accounting or regulatory standards. In this case, we're looking at HGB, which is the German General Accounting Standard, versus solvency. As we view our overall assets, we can further view the asset categories: reinsurance, capital assets, and other assets. And we see that overall, our assets are increasing both on an HGB basis and on a solvency basis. So, assets are not the cause of our life insurance risk exposure increase. So, let's now take a look at our liabilities. As we view total liabilities, we can also see subcategories for eligible capital, technical provisions, cost of capital, and other liabilities. The largest percentage here is our technical provisions for premium and loss reserves. We see that that is increasing both on an HGB basis and on a solvency basis. We've already seen previously from our summary dashboard that the most likely cause is our life underwriting business. So, let's take a look at our life underwriting risk dashboard. Our selectors include company, time period, risk model type, view, such as product category, and business type, or key underwriting attributes such as age. We select individual products. Let's review our breakdown of the various products within this category: endowment, whole life, etc. You can also view the net asset value, or NAV, the shock factor applied to the net asset value, and the resulting impact of the solvency capital required, or SCR, by product. And as we see, there is an increased impact to all products. To visualize those products with the most impact, we can look at our lower right quadrant using the pie chart graph. The key impact to our book will is in temporary life, whole life, endowment, and deferred annuities products. At this point, as the Chief Risk Officer, I would have a dialogue with our Chief Actuary for life insurance, and we would determine whether we wish to continue in all of these product areas or whether we wish to revise our underwriting guidelines or make other adjustments, perhaps to our investment strategy for asset coverage for our life insurance business. This is an example of how a Chief Risk Officer would interact with the Chief Financial Officer and/or the Chief Actuary to detect and analyze negative developments that can impact enterprise risk and solvency management. With SAP BusinessObjects Enterprise Risk and Solvency Management for Insurance Analytic application, insurance companies can leverage the analytical and management reporting functionality needed to facilitate compliance with EU Solvency II and other country regulations. Insurers gain up-to-date visibility into risk and solvency, allowing companies to make fact-based decisions and plans.